I also want to talk about Japan here because Japan is now shaking global markets as the BOJ begins normalizing rates. What, according to you, are the primary risks to global liquidity that was earlier supported by the yen carry trade?
That's a great question. I mean, look, the proverbial Mrs. Watanabe was investing abroad because yields in Japan were miserable, and the carry trade was borrow in Japan and invest abroad. And in fact, it's been made more lucrative by the depreciation of the yen. Um, uh, People look at the US and say, government pressure on the Fed is telling on interest rates. I think equally important is government pressure in Japan on the Bank of Japan, which has kept the Bank of Japan from raising interest rates, either actual pressure or perceived pressure. And finally, there seems to be some willingness in the Bank of Japan to raise interest rates. But even here, there was skepticism after the last announcement that the Bank of Japan hadn't confidently said it is going to do whatever it takes to bring down inflation. Again, Japan, like the US, has had above normal inflation for a long period of time. And the danger is if those expectations get entrenched, which they could well be, then fighting it requires much higher real interest rates. The big problem for Japan, Japan is often a precursor of problems elsewhere, is that it has very high government debt. So high real interest rates needed to pull down inflation will actually make the debt burden even higher because the debt service will start increasing over time. And so the Bank of Japan was trying to have it both ways, keep rates low, but also hope inflation goes away. Now that inflation is more entrenched, it will have to raise interest rates. And as interest rates move into very positive real territory, the government has a problem financing its huge stock of debt. So, jury is still out. Japan would benefit from Mrs. Watanabe bringing her money back and financing Japan's debt. But that will also imply accepting a higher yen, which is going to hurt corporations somewhat. But broadly in this world with the global supply chains, exchange rates have less effect on production than we think.
Right. Dr. Rajan, I want to talk about India now because you warned that India could take decades to catch up with US and China. Tell me what structural reforms in those countries could either accelerate or delay India's catch-up timeline?
Yeah, look, I think most estimates of catch up require nothing to go wrong in India. And our pace of GDP growth increases by 1% or 2, and that we do all the right things while everyone else stands still. And what you just indicated is they're not standing still. They are trying to improve the lot of their people. In the US, one of the big issues has been the amount of regulation that has come in over the years and is frustrating any kind of investment. And that, you're seeing in, for example, these Taiwanese chip factories that are being set up in the US. Again and again, you hear the complaint, oh, so much additional regulation here than in Taiwan, so that's why this is taking time. And what you have is a government in the United States that is very willing to tear up regulations. In fact, maybe overly willing to tear up regulations wherever it sees it, and is not going to do anything about the green transition, is not going to raise costs for industry, which may, be necessary for the longer run well-being of the planet. But that's what it's sort of taken up. And I think, in some industries it's helpful, in some industries it may actually be problematic, but that's and to some extent, the Democrats also are seeing that maybe they should be on the side of the angels and not keep espousing additional regulations that slow down growth, because after all, slower growth means fewer jobs, and they want jobs for the people. So that's something that the U.S. is turning to, which may in the longer run be very, very beneficial for the United States. Um, in China, I think at some point they'll wake up to the fact that their model doesn't work anymore. It used to work, but it requires a fair amount of thought, which is happening, to see why it doesn't work anymore, and they need fixes. Of course, being a more authoritarian economy, it needs people at the top to change their minds, and that's harder than people broadly who see the consequences of these policies. But if China can fix its growth model and focus much more on the innovation, which is huge and plentiful in China, it could also reaccelerate, find new ways of growth. So I think the jury is still out in both countries. Both are looking inwards. And I think, India, from the recent reforms, is also looking inwards and trying to figure out how to up its rate of growth. Hopefully they play out, but it is something that's work in progress.
Right. Because you suggested that India could turn the US administration's reciprocal tariffs into a strategic opportunity by lowering its own tariffs. How can India ensure this doesn't lead to a flood of cheap Chinese goods rerouted through other markets?
Well, I think, as I said earlier, the world is now getting more apprehensive about Chinese goods coming in. And we have to be clever about it. I mean, one way of keeping out overly cheap goods is by letting our currency depreciate. Of course, there's only so much you can do that without inflation becoming a concern within the country, and without the middle class, which has lots of payments to be made in dollars for kids who are studying abroad, etc., rising up in arms and saying, "Why have you let the rupee cheapen so much?" And in India, it's become a political sort of fetish that the rupee cheapening indicates something wrong. That if the rupee sort of dollar exchange rate goes up, you must be doing something terrible. That's not necessarily true. And so many politicians have worried about the rupee dollar exchange rate going above their age. At this point, I think it's above all politicians' age. So I think we're beyond that controversy. But I think if you look at the real effective exchange rate of the rupee, it's just below what its long-term average over the last decade or so has been. So it's not overly depreciated at this point. I wouldn't worry too much, and I would let it find its level. Perhaps if a deal gets done on the tariffs, it will strengthen again. Of course, the rupee is affected not just by trade, but by investment. And if we can make India a better place to invest, if we can enhance prospects of growth, all those things would help the rupee recover more strongly. But again, I would say the rupee is one way we can actually make our exports more competitive. I would also want, I think I've said this in other fora, our businesses to get more ambitious. Too often they're happy sort of playing in the Indian market and trying to keep out foreign companies from competing with them domestically. Fortunately, I think the government is now opening up to more foreign companies into the Indian market so that our companies first get more competitive domestically, but then also can start looking abroad for markets. You can't be saying every time, "Oh, the domestic market is not working that well," but then look outside. Try and invest. I mean, you can't claim investment is weak because the domestic market is weak. No, the domestic market is not your only market. Look abroad and try and invest for the broader world. And this applies as much to services as it applies to industry, to manufacturing.
But with 50% tariffs hitting labor intensive sectors like textiles and gems and jewelry, how should India support small exporters without resorting to unsustainable subsidies?
Well, it should do the deal on tariffs. I understand a deal was available in July for a variety of reasons, which one can speculate on. It went off the table. this is important because, as you correctly point out, our exports actually to the US are not doing badly according to the November numbers. In areas like, cell phones, engineering goods, etc., it's pharmaceuticals, areas that are coming below the tariff, sort of under the tariff wall, so to speak, because those goods aren't tariffed as much. They're doing fine. They're doing fine. It's the areas that are tariffed, like textiles, which are suffering hugely. Tirupur is in deep, deeply worse off. And that there's only so much you can divert some of those exports to other countries because longer run, your relationships in the US suffer. And if you don't have the direct relationship with a Bloomingdale's or with a Macy's, they'll go to Vietnam the next time once they've built those relationships. So I think the longer these tariffs stay higher, the harder recovery is going to be. And of course, some of those companies are going to close down, never to open again. Some of them are going to lay off workers. Workers won't come back because they'll go elsewhere. You know, this is something which needs urgent action. And it's not just subsidies. Where are they going to export to? You need to deal with the tariffs sooner rather than later. And I think this is where we need to, push this hard. I presume that's what's going on, but we need to push as hard for a deal. India has the highest tariffs in the world at this point from imposed by the U.S. And for two countries that claim to be great friends, even in the latest national security reading by the U.S., why are the tariffs so high? And it's not that India has stood still on some of the issues that bug the U.S., such as the nuclear, liability issue, which India just passed a bill on. So I would say we need to push really hard, use all our friends in the U.S. to push for India and get this tariff deal done.
Do you also think part of the delay in reaching a tariff deal is driven by personality based diplomatic friction rather than pure economic data?
I think everything boils down to personality nowadays. But I think personalities should work to get over it. And I would say there's no point sitting on a high horse. I think longer run, economic growth will be our source of independence, and from all pressures. And we need that economic growth, including to build our own defense to much higher levels of quality and responsiveness than today. And I think that therefore do what it takes to get that economic growth.
Right. You've also argued that export-led manufacturing model has largely passed India by. Can a services-led growth strategy realistically generate enough low-skilled jobs for India's massive youth population, according to you?
Absolutely. But let me start by saying I'm not against manufacturing, and I think there are many spots where we could still do a lot in manufacturing. And some of the southern states, like Tamil Nadu, are showing the way by creating an environment hospitable to manufacturing entities coming in. The improvement in our logistics, which the central government has focused a lot on, is huge, and that also helps. And better trained workers are going to be attractive to any entity setting up. Tamil women seem to be the target for a number of Taiwanese and Korean manufacturers coming into Tamil Nadu because they're disciplined workers and well educated and so on. So I think other states in the south are obviously also trying to replicate. The west is doing that. Even the north, Uttar Pradesh is making a bid for industry and so on. What is good is if India remains unified to labor, so that migrants, when there's a shortage in the south, migrants come and enter there. But you can already see, and this we wrote the book Breaking the Mold before the tariffs imposed by the U.S., but we were even then skeptical about manufacturing because of the rise of protectionism and the fact that China was not going to go away and had huge sort of manufacturing capacity. And you're seeing that again and again. Manufacturing is hard. I'm not saying it's impossible, But having another China come in is the world is not ready for that, and that's why we said we need another path for growth. Now, services, high-end services, doing very well. Of course, AI is an issue, and we have to sort of ride on AI rather than let it displace too many jobs. And if we're good, and certainly AI companies are making a pitch for Indian workers, Indian demand. If we can embrace AI, we can be a force, continuing force in services. I saw examples of Indian chip design using AI. That's great. Um, but I think for the jobs en masse, it's not going to be in the high skilled services. It's going to be in moderate skilled services, in plumbers, many more well educated, capable plumbers, in many more construction workers, bricklayers, in low level medical practitioners who can use AI to improve the quality of their advice, but know enough to take, to fix a good bandage on a festering wound and so on. We need so much sort of medical capability that we don't have right now. So I think that urbanizing India, and every small village is really a town by global standards because of our population. The mass demand for services, especially moderate quality services from a growing India, will be huge, and servicing that will be a source of our growth. And that means that we need to focus much more on creating moderate skills. When I see some of the plans that states have for growth, it's always we need more engineers. Yes, you need more chip engineers. You need more R&D. We talked about that in the beginning of the program. But we need many, many more sort of moderately skilled people, because that's where the jobs are. And that means both skilling in schools, but also reorienting our skilling institutions, the ITIs, but also new ones. There are states that have done a good job. Orissa's skilling program has been very good. And we can sort of share these best practices and improve. But I think jobs are a problem if everybody's trying for the IAS, in which, there are a few hundred jobs, or if everybody's wants a cushy government job. There are not enough government jobs. That's not going to happen. But we need to create many more private sector jobs, and that means not just the big companies, formal jobs, but also self-employment in areas like the urban services that we need so much of.
15 to 30 years for India to reach the economic scale of the US or China. What is the single most critical structural reform that could meaningfully shorten that timeline, according to you?
First, just do the math. I mean, this is not a deep scientific estimate. It's just looking at their per capita GDP and asking how long it would take to reach that. If you do the math, you will arrive at similar numbers. That to get to Viksit Bharat, whatever that means, because there's a wide range of meanings applied to what Viksit Bharat means. But if Viksit Bharat means maybe China's middle income country, maybe 50% more income than China today per capita, it requires pretty huge growth rates, probably a couple of percentage points than where we are today. And to get that, I think absolutely focus on your human capital at every stage. That is, I mean, this is what Amartya Sen has been saying for a long time. It makes a lot of sense. Right from, deal with the problem of malnutrition. Your malnutrition kids are going to be your labor force in your Viksit Bharat. Imagine people with stunted brains having to deal with a first world economy. That's what you're setting them up for. It's unconscionable first as a country to have kids with that level of malnutrition, but it's also throws a lot of sand in your dreams. So that's something to fix. It's not. It's a hard problem. We've tried, but we need to do more. We have the resources to do that. It's now the kind of programs to see whether they're effective. Better, primary schools, secondary schools to train our kids up. More vocational training in higher education. But then improve the quality of your universities also. We have a huge number of graduates with degrees that aren't worth the paper they're written on. And they go and spend 3 4 years and then spend another 10 years taking all these exams because they want white collar jobs and end up nowhere at the end of it. What we need to do is make the alignment between skills and jobs much more effective. And that means taking a very, very hard look at the whole process. And finally, we need really high quality, top level universities. We had better universities than China, I would argue, at the beginning of this century. Now China has many more top quality universities than we have. Something went wrong as we didn't keep up. Of course, China had more resources because of its growth, but now we need to invest in our top universities because they're going to be the ones doing the research and development, which is needed for industry, but it's also going to be the place where they train the teachers.
But despite the China plus one narrative, companies often choose Vietnam or Mexico. What is the key missing piece in India's business environment that limits our ability to fully capture this shift?
Well, it's at every stage, but I think we're working on some of it. Logistics, as I said, has improved tremendously in India. The quality of infrastructure is much better. But if you want FDI, you also want quality of life. And this is where, having a gas chamber that Delhi has become as your capital city is not good advertisement. Of course, other cities are much more livable at this point, but it is something to pay attention to. Bangalore, everybody complains about the traffic. So quality of life is another issue. Business certainty is important. I just saw an academic who told me about this paper they were working on, which suggested that the Vodafone retrospective taxation did have a tremendous negative effect on FDI. Now, I haven't seen the paper. I don't know the quality of the analysis, but I wouldn't be surprised that the constant sort of shifting of our regulations based on either the needs of the bureaucracy for safety and protection or needs of business for protection against foreign entrants keeps our business environment very uncertain. I mean, nowadays, where is the tariff going to go up? Is it going to be on my inputs? We need a stable tariff regime at moderate, very moderate tariffs rather than at high tariffs if we are going to be part of a global supply chain. So these are the things we need to work on. Of course, our labor force needs to. We keep saying 1.4 billion Indians. That's great, but how many are trained to do the kinds of jobs that are coming in, and how many are willing? You need both the skills as well as the willingness to take up those kinds of jobs. We need more effort here, but things in India change, and they are changing in the right direction. They often take more time than you would wish. Um, the tough part is the world is moving ahead. We don't have the luxury of a lot of time, so we need to move also.
But with political pressure on the US Fed to cut rates, how should the RBI balance maintaining the India US rate differential to support the rupee while still managing domestic growth?
Well, I will say this again. I don't think rupee depreciation is that much of a problem at the low rates of inflation we have now. Of course, inflation will go up. This is unusual that we are at the bottom of the band that the RBI set out to do. I think inflation targeting that the RBI set out, has been quite successful so far and has brought down inflation to a level we never really experienced before. And that's been good. But now it's time to sort of harvest some of those benefits, which means that we can be a little more flexible on the exchange rate and allow the exchange rate to find a level consistent with the ambitions of our industry. Now, if our industry doesn't want to go outside, then it's tougher. But I think the government has to tell industry, okay, we're willing to do what it takes, but you better show some gumption of your own. And I say again and again, what we need is industry to be more ambitious and to be government to be more supportive of that.
Should the RBI strictly adhere to its 4% inflation target, or is there room to redefine price stability in an era of repeated global supply shocks?
I keep saying, what ain't broke, don't fix it. We've successfully targeted inflation. When I started, um, nearly 10 years ago, actually over 10 years ago, 12 years ago, people didn't believe we would have a reasonable inflation targeting regime. And so we had to work through a glide path towards that. And then we've stuck. And this is one of the successful institutions we have built. Why break it at this point when it's working really well? Industry will come up again and again and say, "Oh, interest rates are too high." There's never been a point where industry has been satisfied with interest rates. The issue is not interest rates. The issue is inflation, which hurts our people tremendously. And it's important to keep inflation contained. And the issue is everything else that goes into creating a better business environment. Inflation has been taken out of the equation. And now it's time to take the other stuff out of the equation, whether it's policy uncertainty or whether it's the quality of the labor force. These are outside the RBI's remit.
If you were still at the RBI today, would you do anything differently?
Well, I don't want to serve as either a critic or an endorsement of current RBI policies. I would say where we are is pretty good.
Okay, Dr. Rajan. Thanks for your time. Thank you really for speaking with us today. It was insightful.
Thank you. Same to you.
Thanks.
And thanks for doing this.